Welcome everybody. My name is Niko Casagrande, and today I will be speaking about the future of enterprise engagement with public blockchains. And this is quite an extensive topic, so I will do my best in the 20 minutes I have to cover as much good stuff as I can. And quick disclaimer, any views and opinions that I express today are my own, and I'm in no way representing my employer or any other organization. So, real-world assets in DeFi. Who has a lot of real-world assets? Well, enterprises do. And the more real-world assets are enabled in DeFi, the more we will see enterprise engagement with public blockchains. And let's look at a couple examples. So loan financing. New Silver is a company that makes real estate loans. And with the help of Centrifuge, they have tokenized these loans on Ethereum, and they deposit them in Maker as collateral and use them to mint DAI stablecoins. And then they use these stablecoins to finance new loans. So essentially, this is like a $5 million credit line for New Silver. And of course, a difference from a traditional line of credit is that this provides instant liquidity every hour of every day of the year. But New Silver has been able to effectively unlock value from their assets. And let's look at another example here, security tokens refinancing. Societe Generale, or SocGen, they've made a proposal to Maker governance to use bonds that they have issued on Ethereum as collateral. And these tokens, they represent covered bonds backed by home loans. And they want to use them as collateral in Maker to, again, withdraw DAI stablecoins. Now, this example is kind of similar to the New Silver example, but a big difference is that whereas New Silver is a relatively small company that most people have not heard of, that SocGen is the 6th largest bank in Europe, one of the largest banks in the world. And they proposed that they'd be able to use 40 million euros of collateral to mint up to 20 million stablecoins. So this will be an interesting proposal to keep an eye on. This could be the tip of the spear. And if successful, then we may see a lot more institutional investment managers and enterprises at large taking advantage of public chains and DeFi to unlock value from their existing assets. Baseline Protocol. Baseline Protocol, it's an open source initiative. It has participation from some big names like Microsoft, AMD, Consensus. And it's an approach to using the public Ethereum mainnet as a common frame of reference. And this allows traditional corporate systems of record to stay in agreement with each other. So let's look at this graphic here. At the top, we have Ethereum mainnet, and then we have 3 enterprises. And each enterprise uses their own record-keeping systems. So the one on the left uses Oracle and SAP, the one in the middle uses Salesforce, and so on. And using Baseline, they're able to collaborate between themselves and keep their systems in agreement without leaving any sensitive data on the public chain. The only data on the chain are hashes of proofs that business processes were followed correctly. So this can help with automating business processes across multiple companies, and all of the enterprise's data remains in their tried and tested record-keeping systems behind their enterprise firewalls. So Kona, Cocoa North America, they're doing a pilot to see if Baseline can help them to onboard suppliers more quickly and easily. You can imagine how big their supply chain is. And also to reduce disputes and errors. And EY, one of the big 4 accounting and consultancy companies, they have developed a supplier procurement system using baseline. So this concept of using a public blockchain as middleware is quite powerful and can unlock a lot of use cases for enterprises. Enterprise-ready DeFi lending pools. So one of the reservations that enterprises have with interacting with lending pools in DeFi is that because they don't know all of the participants in the pool, there's a risk that they could somehow be interacting with a money launderer or worse, right? And no enterprise wants that. So now we see solutions that are in various stages of deployment and adoption that aim to address this concern by making the pools permissioned. So Aave, one of the biggest permissionless lending pools, they popularized flash loans. They have developed Aave Arc. So these are permissioned lending pools, and all participants must be whitelisted. So they must all pass know your customer checks, anti-money laundering checks. And this is to assuage some of the concerns of enterprises. Now, perhaps this will serve as a gateway to permissionless DeFi for institutional investors in the future. We'll see. Compound, another very popular permissionless lending pool. They have now come out with Compound Treasury. You may know Compound popularized liquidity mining. Many people use Compound. Now they have Compound Treasury for large holders of US dollars. So it provides a fixed rate of interest. And whereas for many enterprises, DeFi is new and unfamiliar, perhaps they're not sure they understand all of the risks, Compound Treasury aims to abstract away that complexity for non-crypto native companies. Present it in a more familiar way. Alchemy, again, KYC compliant DeFi lending pools with institution grade reporting. In fact, all of these offerings have reporting that enterprises expect. And Maple Finance, they're offering under collateralized lending pools for institutional borrowers. So whereas with permissionless pools, lenders are protected through an over collateralization auto liquidation model. With a permissioned pool, you can give out loans based on real world metrics like reputation, like credit scores, and so forth. And so that's what Maple is doing. Off-chain computation. Performing computation on a properly decentralized blockchain can be slow and expensive. And there are scaling solutions such as side chains like the POA network, like commit chains, such as Polygon, which has been growing by leaps and bounds. But especially exciting are rollups. Rollups are often referred to as layer 2 scaling solutions. And rollups do the computation off of the main chain, so it's faster. They commit transactions back to the main chain in batches or rolled up. And in that way, they inherit security properties of the main chain and save on transaction fees. So let me give a real world example here. DYDX. DYDX is a decentralized exchange that does leveraged trading. They've been around for a while, originally deployed on Ethereum. And now they've deployed on a zero knowledge rollup from Starkware. And DYDX now is doing 2 to 5 times the total capacity of Ethereum for less than 1% of the transaction costs. And that 2 to 5 times metric, that is not a limitation of the rollup. That is just what the demand for DYDX happens to be. As the demand for DYDX grows, this rollup can scale further. So that shows the power of layer 2 rollups. And this concept of modular blockchains, where the consensus is done on the main chain, but the execution is done off chain, and even the data availability can be off-chain. This is terrific for enterprises. Enterprises are, when it comes to dealing with public blockchains, they're concerned about permissioning and performance and privacy. And enterprise layer 2s or enterprise rollups can address all of these things. They can address scalability, cost savings. You can do private transactions. You can even have your data storage off-chain. So EY have developed Nightfall, and that is a protocol designed for enterprises to be able to do private transactions on a rollup. But enterprises don't need to build these rollups from scratch. They can use kind of a rollup as a service like offered by Aventus. And bridges. So bridges allow the transfer of value between chains or between layers. And here we can see a public blockchain in the center, Ethereum, and around it are things like side chains and rollups and enterprise chains. And in the past, bridging was always done through the main chain. So if you wanted to send value from a side chain to a rollup, first do a bridge from the side chain to Ethereum, and then from Ethereum to the rollup. But now we see solutions coming online that interconnect everything, that basically build bridges, direct bridges between everything. And I've heard of this kind of interoperability described as layer 3, but this is great for enterprises because now enterprises will be able to interact with multiple chains, multiple rollups and scaling solutions, a whole ecosystem much more easily. The interoperability is key. Stablecoins. Well, you see the top 4 here, adding up to over $128 billion in market cap, and this number just keeps growing and growing every day. Enterprises can and are using stablecoins for payments due to lower transaction fees, real-time settlement, any hour of any day, no holidays, no weekends, and enterprises can do international payments without having a banking relationship in the foreign country. That can be huge for an enterprise, but enterprises can also create their own stablecoins. They can create branded stablecoins, and there's some benefits there for an enterprise. For example, revenue. There are revenue opportunities. If the stablecoin is backed by fiat reserves, then the enterprise can earn interest on those reserves. The enterprise can encourage customers to pay with a stablecoin by rewarding them with perks and features and discounts. And every time somebody sees or uses that stablecoin, that branded stablecoin, well, there's a bit more brand awareness. And again, the enterprises don't need to build these stablecoins from scratch. They can use stablecoin as a service offerings, like from Paxos or Stably. Oracles. Oracles provide smart contracts with off-chain external data. And some examples of data that's fed on-chain today are things like prices of real-world assets, fiat currency exchange rates, supply chain data, maybe sensor data from supply chains like temperature, humidity, events data like flight departures can be used in travel insurance protocols. And there are many more examples. And if you look at this graphic, if we pick a public chain in the center, say Ethereum, around in the circles, we have all these entities feeding data to the public chain, things like bank payments, financial market data, events data, and data from enterprise backend systems. And in this example, they're all being fed on chain by oracles enabled by Chainlink. Now, what's interesting for enterprises is that enterprises own a lot of data, right? And a lot of that data is only valuable to the enterprise itself. And if it does have value outside of the enterprise, it's often not economically viable to try and distribute and sell it. But with the rise of public blockchains, the growth of marketplaces on public chains, we can see new use cases emerge that make that enterprise data more valuable. And with oracles, we have a new distribution mechanism. So that can change the equation in terms of the business case. And it will be very interesting to see how enterprises are able to monetize data in the future that today they are not able to monetize. And to wrap up here, just a few more thoughts. Coupons, those will move more and more into public chains. Enterprises will put them there. They will become more transferable and saleable. But what's interesting is the additional functionality that can be built in, because everything is programmatic on the public chain. So today, perhaps a coupon can give you 10% off of the purchase price. On chain, the coupon could give 10% of the purchase price to the public address of a charity. And it's all automatic, it's all instant, and it's all verifiable. So new use cases for coupons. Similar loyalty points, those will move more and more onto public chains, and various advantages to enterprises, one of which is enterprises can then use the blockchain data to do big data analysis to get customer insights and for marketing intelligence purposes. And for the holders, it makes these points more liquid, more useful, and hence more valuable. Non-fungible tokens, or NFTs, these have exploded over the past year or so. Enterprises will, more and more enterprises will be minting these, using them to grant special access to things or to events, rewarding their brand ambassadors who promote their brands and products on social media. More and more will mint branded collectibles, and these will be used in the metaverse. And indeed, we are going to see a wave of enterprises rushing to participate in Web3 and the metaverse. And Web3 and the metaverse are enabled through digital ownership as represented by NFTs. And ownership and control. So we can see enterprises issuing more tokens representing shares or some sort of voting rights. We can imagine, what if Uber issued some tokens to every rider or driver when a trip was completed. Those tokens perhaps could offer some sort of share of income, or perhaps they're just voting rights over something, maybe what the next feature of the mobile app should be. But the point here is that enterprises can use tokens to build communities, and they can incentivize those communities to provide honest and ongoing feedback through voting. And this can obviate the need for doing as much market research or as many focus groups. And decentralized autonomous organizations, or DAOs, these are becoming more and more popular, and the DAOs that are starting today is quite small, may someday scale to rival the largest corporations. And in the future, we can see a DAO or a federation of DAOs competing directly with large enterprises. And enterprises themselves can harness the power of DAOs internally in their own operations. So enterprises can use DAOs to incentivize, compensate, and empower their employees or non-employees to use their collective wisdom to guide next best actions and how to most efficiently run their internal operations and functions. So it'll be very interesting to see going forward how enterprises are able to use DAOs for themselves. And with that, I'd like to thank everybody, and perhaps we have time for a question or two.
Absolutely. I have many questions, Nicholas, just personally, that I'd love to put across. So first and foremost, this is incredibly refreshing, hearing someone whose primary role is at a retail bank talking about DAOs and NFTs and ceding control to DAOs even internally within an organization. I'd love to know if you can speak about any of the initiatives that Citizens Bank is actually looking at moving forward in sort of 2022.
Sure, I'm not really able to comment on that too much today. I'm really here more as an individual. Now, I do work at Citizens. I do work in digital strategy and innovation. And so these are things that, of course, I'm always thinking about. I also am a member of the Enterprise Ethereum Alliance, and I co-chair the financial services group there and the DeFi group as well. So these things are top of mind. But really today, I'll just represent myself.
Okay, very good. I was impressed with the risk warning before the very expansive presentation. Yeah, I know that needs to be done in case anyone throws their money into certain chains and what have you. I don't know if we've got any questions from the audience. It's great. Christina's mentioned that, so refreshing hearing, obviously with your position and representing TradFi amongst other organizations. You covered a lot within the presentation, which was great. And one of the things you brought up was the ability to move transactions to layer 2, especially when we look at, one of the, sort of, I would say, stellar stars this year with DYDX in terms of transaction volume moving over to Starkware. We also saw a few issues with DYDX this year. So I think it was maybe last week we saw the centralized dependency on kind of that layer 2, where I believe it was AWS East or AWS West had a lot of teething problems for a day or so, and brought everything grinding to a halt. What are the steps which are being made on layer 2 to maybe perhaps guard against that kind of particular scenario where a big web server goes down? Is there anything being put into place?
Yeah, so these are growing pains. There are a lot of lessons to be learned, and I think the team at DYDX now, we'll see what changes they end up putting in place. But in general, there's a difference here for when there's a retail user versus when there's an enterprise user. And for retail users, you can do as much or as little due diligence as you like on whatever services you use, whether it's in the world of DeFi or anything else online, right? But when it comes to enterprises, there's a lot more due diligence that needs to happen. All of the risks need to be understood. And we will see at some point, I believe, a set of attestation standards coalesce that auditors and other organizations will be able to use to kind of standardize how to measure the risks and how to ensure compliance with certain things, whether it's KYC, whether it's decentralization or having too much running in one region in AWS, all of these things. We're not even close to having that yet, but there are a lot of people that see the need for this, and I have started to see some movement on different parties coming together as a community to try and come up with these standards, because it needs to be community-based. It needs to come out of a community. Nobody can just come up with these things and kind of dictate them to everybody. So that's an area to keep an eye on, I think.
I think it's a great point. I find I do a few of these presentations, and we always kind of go into identity. We always end up going into AML. And if you kind of look at things from a more traditional perspective, there are many other factors which need to be considered if we're truly going to replicate, some of these instruments into a more decentralized world. You look at things like best execution, institutional grade market data, especially with us all becoming millionaires for about an hour on coin market cap last week, and a number of people's pricing getting thrown horrendously wrong, and really exposing that these needs need to be fulfilled. Are there any particular areas that you can see being sort of focused on in the sort of the near term, which are maybe sort of sit outside of some of the topics that we typically discuss within these types of panels that you're seeing?
Well, it all starts and has started, and there's been a lot of progress made on looking at the individual smart contracts and coming up with standards on how to measure their security. Then it gets kind of almost exponentially more complicated once you start bringing in how that smart contract interacts with the wider ecosystem and with oracles and all that sort of thing. But I think, there's kind of almost like the technical view, and then there's more of the traditional business view, and then there's the regulatory view as well. And all of these perspectives will be needed. And I do see people start to look into, and it was kind of touched on earlier, but the whole KYC AML piece is just growing in prominence, and that is where I see most of the attention in terms of both the business and regulatory views looking at now. And from the technical view, besides the smart contracts, it's really more around kind of the tokenomics and also oracle risks. So yeah.